Right now, millions of Canadian homeowners are about to face the most brutal financial reality check they have ever experienced, and the Bank of Canada knows it. They have been watching this crisis unfold in slow motion for years, and now the moment of truth has arrived. We are talking about a wave of mortgage renewals so massive, so financially devastating, that it could fundamentally reshape the Canadian housing market and send shockwaves through the entire economy. This is not fear-mongering. This is math, and the numbers do not lie. If you want to stay ahead of what is happening in the economy and understand how these massive shifts could affect your wallet, your investments, and your future, make sure you hit that subscribe button right now and turn on notifications so you never miss an update. Trust me, you are going to want to follow this story as it unfolds. Let me paint you a picture. Imagine you bought a home back in 2020 or 2021. The world was in chaos, but interest rates were at historic lows. The Bank of Canada had slashed rates to nearly zero to stimulate the economy during the pandemic. You locked in a mortgage at somewhere between 1.5% to 2%. Your monthly payment was manageable. Life was good. You figured you made a smart decision, and honestly, at the time, you probably did. But here is the thing about Canadian mortgages that most people do not fully appreciate until it hits them right in the face. Unlike the United States, where a 30-year fixed mortgage actually means your rate is locked for 30 years, Canadian mortgages typically renew every 5 years. That means every half-decade, you are essentially renegotiating your mortgage at whatever the current market rate happens to be. And this is where the story takes a very dark turn. Fast forward to today. Those pandemic-era mortgages are coming due. Homeowners who locked in at rock-bottom rates are now staring down the barrel of renewal rates that are 2, 3, sometimes even 4 times higher than what they were paying before. We are not talking about a minor adjustment here. We are talking about payment increases of hundreds, sometimes thousands of dollars per month. For many families, this is not just uncomfortable, it is financially catastrophic. Let me give you some real numbers to put this in perspective. According to data from the Canada Mortgage and Housing Corporation, approximately 4.5 million mortgages are set to renew between 2024 and 2026. That represents the single largest wave of mortgage renewals in Canadian history. And the overwhelming majority of these mortgages were originated during that golden window of historically low rates. Now think about what this means on a household level. A family that took out a $500,000 mortgage at 1.8% would have been paying roughly $2,000 per month. When they renew at current rates, which even after recent cuts are still hovering around 4 to 5%, that same mortgage payment jumps to nearly $3,000 or more. That is an extra $1,000 vanishing from the family budget every single month. That is $12,000 per year. That is money that used to go toward groceries, childcare, savings, vacations, and spending in the local economy. Now it is going straight to the bank. And here is where the Bank of Canada enters panic mode, though they would never use those words publicly. The central bank has been walking an incredibly fine tightrope for the past 2 years. On one side, they needed to raise interest rates aggressively to combat the worst inflation crisis in 4 decades. Mission accomplished on that front mostly. Inflation has come down from its peak of over 8% to something closer to the target range. But on the other side, they know full well that every rate hike they implemented was planting a time bomb under the housing market set to detonate when those pandemic mortgages came up for renewal. The Bank of Canada has access to data that most of us never see. They have been tracking this mortgage renewal cliff for years, running simulations, stress testing scenarios, and watching with growing concern as the numbers kept getting worse. Their own internal analyses have shown that a significant percentage of renewing households will face severe financial strain. We are talking about debt service ratios climbing to dangerous levels, household budgets stretched to the breaking point, and a real risk of rising mortgage defaults. Now you might be thinking, well, the Bank of Canada has been cutting rates recently, so is the crisis averted? Not even close. Yes, the central bank has begun easing monetary policy, and there have been several rate cuts over the past year. But here is the critical detail that gets lost in the headlines. Even after these cuts, rates are still dramatically higher than they were during the pandemic borrowing boom. A rate cut from 5% to 4.5% helps at the margins, but it does not fundamentally change the math for someone who locked in at 1.5%. The gap is simply too large. The damage is already baked in. The Bank of Canada knows this, which is why if you read between the lines of their official communications, you can sense the anxiety. They are trying to engineer a soft landing, but they are running out of runway. Let us talk about what this means for the housing market itself, because the implications are staggering. When millions of households suddenly have significantly less disposable income, consumer spending takes a massive hit. This is not theoretical. We are already seeing it in the data. Retail sales have been sluggish. Restaurants are closing. Consumer confidence is wavering. The economic multiplier effect works in both directions. When people have extra money, they spend it, and that spending creates jobs and growth. When that money disappears into mortgage payments, the opposite happens. The economy contracts. But the housing market faces an even more direct threat. As more homeowners find themselves unable to afford their new mortgage payments, the number of distressed sales is going to increase. We are already seeing early signs of this in certain markets. Listings are rising. Days on market are extending. Price growth has stalled or even reversed in many areas. And this is just the beginning. Think about it from a simple supply and demand perspective. If a wave of homeowners are forced to sell because they cannot afford their payments, that adds supply to the market. At the same time, potential buyers are sitting on the sidelines because they cannot afford to borrow at current rates, which reduces demand. More supply plus less demand equals falling prices. This is Economics 101. Now, I want to be careful here because I am not predicting an absolute housing crash. Canada has certain structural factors that tend to support housing prices, including strong immigration, limited land in desirable areas, and tight rental markets. But what I am saying is that the fundamental dynamics have shifted dramatically, and the direction of travel is clear. We are entering a period of significant housing market stress, and the Bank of Canada is acutely aware that their policy decisions contributed to this situation. Here is another factor that does not get nearly enough attention: the psychological impact of this mortgage renewal shock. For years, Canadians have treated their homes as piggy banks, and retirement plans rolled into one. The assumption was always that housing prices would keep rising, building equity, creating wealth. But when your monthly payment doubles and housing prices stagnate or fall, that entire financial model breaks down. Suddenly people feel poorer, even if they have not actually lost their jobs. And when people feel poorer, they act poorer. They cut spending. They delay major purchases. They become more conservative with their money. This sentiment shift alone can trigger a negative economic spiral. The Bank of Canada has been watching consumer confidence indicators with growing concern. They know that monetary policy works as much through psychology as through actual interest rate mechanics. If consumers lose faith in the economy, if they start believing that things are going to get worse, that belief becomes self-fulfilling. And right now, the mortgage renewal crisis is creating exactly the kind of negative sentiment that central bankers fear. Let us also talk about the regional disparities, because this crisis is not hitting all parts of Canada equally. The areas that saw the most aggressive price appreciation during the pandemic boom are now the most vulnerable to this mortgage renewal shock. Greater Toronto, parts of the Greater Vancouver area, and other hot markets where buyers stretched to the absolute limit to get into the market are now facing the harshest reality checks. In these markets, many buyers were already at the very edge of affordability. They bought at peak prices with pandemic low rates, creating the perfect recipe for financial disaster. When their mortgages renew, they have nowhere to go. They cannot sell without taking a loss because prices have come down from their peaks. They cannot refinance at better rates because rates are still elevated. They are trapped, and this feeling of being trapped is creating enormous stress and anxiety across the country. The banks themselves are also getting nervous, though they are doing their best not to show it. The major Canadian banks have been building up their loan loss provisions, essentially setting aside money to cover expected mortgage defaults. When you see banks quietly preparing for trouble, that tells you something about what the smart money expects to happen. And yet, despite all of this, you have not seen mass defaults or a true housing market collapse. Why not? Part of the answer lies in the various Band-Aid solutions that have been applied to delay the pain. Longer amortization periods have been offered to struggling borrowers, stretching out their loans to reduce monthly payments. Some lenders have offered modified payment plans or temporary relief measures. The government has introduced various support programs aimed at helping first-time buyers and struggling homeowners. But here is the dirty secret about these Band-Aid solutions. They do not actually fix the problem, they just defer it. Extending your amortization from 25 years to 30 years reduces your monthly payment, sure, but it also means you pay dramatically more interest over the life of the loan and build equity much more slowly. You are essentially choosing between short-term relief and long-term financial damage. And millions of Canadians are being forced to make this impossible choice right now. The Bank of Canada is stuck in an incredibly difficult position. They want to cut rates faster to provide relief to struggling mortgage holders, but they also need to be careful not to reignite inflation or completely destabilize the currency. Every decision they make involves trade-offs, and right now there are no good options. Only less bad ones. What makes this situation particularly frustrating is that many people warned this was coming. When rates were at historic lows and housing prices were skyrocketing, there were voices cautioning that this was unsustainable, that borrowing at rock-bottom rates to buy at sky-high prices was a dangerous gamble. But in the heat of the moment, with fear of missing out driving decisions and real estate agents promising endless appreciation, those warnings were largely ignored. Now the bill has come due, and it is larger than many people ever imagined. The Bank of Canada is scrambling to manage the fallout, but there is only so much monetary policy can do when the fundamental problem is that people borrowed more than they could afford, expecting conditions that no longer exist. Looking ahead, what should we expect? In the near term, probably more rate cuts from the Bank of Canada as they try to provide whatever relief they can. But these cuts will be measured and gradual because cutting too fast brings its own risks. The mortgage renewal wave will continue to work its way through the system over the next 2 to 3 years, creating ongoing pressure on household budgets and the broader economy. Housing prices in the most overheated markets will likely continue to soften, though the extent of any decline will depend on numerous factors including immigration levels, interest rate trajectory, and overall economic conditions. The rental market will remain extremely tight because people who might have bought homes are now stuck renting, adding demand pressure to an already strained rental stock. Consumer spending will remain subdued as households prioritize debt payments over discretionary purchases. This will create headwinds for businesses across the economy, potentially leading to job losses in sectors dependent on consumer demand. And if job losses materialize, that creates a negative feedback loop, where people who lose their jobs become even less able to afford their mortgages, potentially accelerating the whole cycle. The Bank of Canada is watching all of these indicators obsessively, trying to calibrate their response in real time. They are in communication with the major banks, with regulators, with the federal government, all trying to coordinate a response to what they understand is a genuine economic emergency, even if they cannot call it that publicly. For individual Canadians, the message is clear. If you have a mortgage renewal coming up, prepare now. Run the numbers on what your new payment will be. Build up your emergency fund if possible. Consider your options carefully before committing to any particular path forward. Talk to a financial advisor if you can afford one. And above all, do not assume that rates will return to pandemic levels anytime soon. The era of ultra-cheap money is over, and planning based on its return is a recipe for disappointment. If you are thinking about entering the housing market, proceed with extreme caution. The current environment rewards patience more than urgency. Do not let fear of missing out push you into a purchase you cannot truly afford. The market conditions that created this crisis have not fully resolved, and there may be better opportunities ahead for patient buyers. Will affect your job security. Will affect your job security, your investment portfolio, the businesses in your community, and the overall economic trajectory of the country. We are all connected in this economic ecosystem, and when millions of households are under severe financial stress, nobody escapes completely unscathed. The Bank of Canada is not actually going to hold a press conference and announce that they are in panic mode. Central bankers do not do that. Their entire job depends on projecting calm confidence even in the most turbulent circumstances. But when you look at the data, when you listen carefully to their carefully worded statements, when you observe their increasingly frequent rate cuts, the picture becomes clear. They're deeply concerned about what is unfolding, and they are using every tool at their disposal to try to prevent a worst-case scenario. Whether they succeed or not remains to be seen. The next 18 to 24 months will be critical in determining whether Canada achieves the elusive soft landing or something harder and more painful. One thing is certain, though. The Canadian housing market and the millions of families who depend on it are entering a period of unprecedented uncertainty and stress. This is one of the most important economic stories unfolding in Canada right now, and it deserves your attention. The decisions being made by the Bank of Canada, by the federal government, by the banks, and by individual households will shape the Canadian economy for years to come. We are living through a genuine inflection point, and understanding what is happening is the first step toward navigating it successfully. I hope this breakdown has helped you understand the scope and significance of what is unfolding. This is complex stuff, but it matters enormously for anyone who owns property in Canada, rents property in Canada, or simply participates in the Canadian economy in any way. If you found this video valuable, please hit that like button. It helps more people find this content and understand what is really happening in the economy. Drop a comment below and let me know your thoughts. Are you facing a mortgage renewal? How are you planning to handle the payment increase? Or maybe you have a different perspective on how this will play out. I read the comments and I genuinely want to hear from you. And if you have not already, make sure you subscribe to the channel and turn on notifications so you never miss an update. I will be following this story closely and bringing you more analysis as events unfold. The Canadian economy is at a critical juncture, and staying informed has never been more important. Thank you for watching, and I will see you in the next one.